Hello, and welcome to an excerpt from Study Unit 4 of GLIME's 11th Study Unit Financial Accounting Made Easy course. For those of you joining us for the first time, my name is Cameron. In this 3-minute video, we will explain debits and credits by building upon the basic accounting equation, which is assets equals liabilities plus equity. As you watch the audio-visual presentation, remember the terms debit card and credit card are creative terms used by the banking industry to identify and market each card. These card names do not relate to the accounting terms debits and credits. Now, let's jump into the audio-visual presentation.
The words debit and credit, abbreviated DR and CR, simply mean left and right. Do not assume that debit means to decrease or credit means to increase. Just remember that debit means left and credit means right. Amounts entered on the left side of any T account are called debits, and the account is said to be debited. Relatedly, amounts entered on the right side are credits, and the account is said to be credited. Consider the expanded accounting equation. Assets plus expenses equal liabilities plus equity plus revenue. Assets and expenses are on the left side of the equation, and they normally have debit balances. This means that debits increase asset and expense accounts, and credits decrease them. Liabilities, equity, and revenue are on the right side of the equation, and they normally have credit balances. This means that credits increase liability, equity, and revenue accounts, and debits decrease them. Recall from Study Unit 3 that if a transaction changed the balance in one account, another account would also have to be affected in order for the accounting equation to remain true and balanced. For example, assume that an entity buys a computer with a note payable for $1,000. Because the computer is an asset, the entity's total asset balance increases by $1,000. But adding $1,000 to the asset balance will leave the accounting equation unbalanced. The asset and expense side of the equation will be $1,000 greater than the liabilities, equity, and revenue side. Therefore, another account needs to be adjusted to keep the equation balanced. Because the computer was purchased with a note payable, which is a liability, $1,000 must be added to liabilities. Since both sides of the accounting equation have now been increased by $1,000, the equation is in balance, and debits equal credits. This balancing, known as the principle of duality, is the essential concept underlying the double entry system. Every transaction must have at least one debit and at least one credit, and the total dollar amounts for all debits and all credits must be equal. In the computer example, the debit is $1,000 to equipment in assets, and the credit is $1,000 to notes payable in liabilities.
The remainder of Study Unit 4 explains T accounts, journal entries, ledgers, and trial balances. To view the rest of Study Unit 4, or to start a free trial of Study Unit 1, visit us on the web at www.glime.com/fame. You may also call one of our expert professionals at 1-800-87-GLIME. That's 1-800-874-5346. Experience the pride that comes with success.